Great to have you. The Fed has been on hold with rates for almost a year now. They've implicitly suggested they feel as if the cost of patience is pretty low in terms of how the economy is performing. I guess you're arguing that seems to be changing right now.
Absolutely. The Federal Reserve has looked to strengthen the labor market, strengthen the overall economy, is giving them the luxury of time to get more data. We'd all like more data to know that things are going better. Unfortunately, over that period of time, the labor market's moderated. The economy is moderated. They don't have that same place of strength, and they are not changing their story and their logic, which in a risk management sense should raise some real eyebrows. The world is changing, and the Fed seems very much stuck in this backward-looking, data-dependent mode, even as we get good data.
Yeah, I guess you're saying that risks are rising. That I suppose that the weakness in the labor market will reach that threshold that you focus on that suggests that it's further upside from there. In other words, just saying, oh, we have a structurally tight labor market and unemployment is only 4% is not much of a comfort.
Correct. And really, the argument at its core to begin cutting rates is that we have made a substantial progress towards the 2% target. Right? We are talking about a first rate cut, a gradual cut, a managed cut. The Fed has amped up the bar on this to a place that, frankly, it is of itself risky in the way it's tying it to data and thinking so hard about this first rate cut. I'm not suggesting they go out and cut rates by 200 basis points at the next meeting. Right? We're not there yet in terms of the target, but we are well on our way, and the Fed has a dual mandate, and it needs to balance the two.
Claudia, how much are you paying attention to the neutral rate? That's the theoretical level where borrowing costs neither stimulate nor slow the economy, because there's a school of thought that believes that it's actually much higher. So ultimately, if and when the economy does slow, does that mean we should expect fewer rate cuts than we're used to over the last few economic cycles?
We need to focus on the immediate decisions. Right. So as I said, I don't want to make any pre-commitments. You start 25 basis points every other meeting. You do 200 basis points. Like, it would be absolutely inappropriate. We just don't know enough for the Fed to be making those kind of decisions right now. Those kind of let's think about the whole suite, like everything we're going to do from here until stopping. You would need to know the neutral rate to do that. Right. We don't know that. And we can comfortably say, looking at credit, stresses on, households that deal with needed debt, that we are well from a neutral place where the Fed is having no effect on the federal funds rate. So no effect on the economy. So we don't need to have that neutral rate discussion right now. We need to have the discussion about where we headed the next year, the next 2 years, just in terms of how the inflation and the interest rates evolve. And I think the long run is maybe less informative than people would like to have that discussion be.
Yeah, it always was obviously kind of a vaporous sort of concept in terms of the neutral rate. Although I do wonder what you'd be looking for right in the near term here. Steve was talking about the focus on weekly unemployment claims. And I guess you're suggesting that, essentially there's not much chance we reaccelerate on the inflation side. So what are you most acutely focused on in terms of deciding whether the economy is just decelerating to a normal, sustainable rate or perhaps weakening to beyond the point we'd like?
I absolutely agree with Steve that I should be on the labor market in terms of the risk to the other side. And here, unemployment insurance claims, looking at unemployment, the unemployment rate, not the level. It is very low, but it has drifted up. And that can often be a sign that we are moving towards, and sometimes that's when we're in the recession. The turning points in the labor market can be pretty subtle. We need to pay attention because once that goes, you break that very virtuous cycle between the consumer and the worker that we have benefited from in this recovery and should keep going into the expansion. So you're looking for some pretty subtle clues. It's maybe not surprising that the labor market has been very hard to read in terms of its strength or its weakness, but pay attention to the changes. Right, where things start to fall off of what have been some very strong readings in the past year, 2 years plus.